This is the economic challenge the Trump administration faces as we move deeper into 2026. According to economic data from multiple sources, the US dollar has experienced significant volatility in recent months. Trade policy changes, international economic relationships, and monetary policy decisions are creating what economists describe as a complex and challenging environment for American economic strategy. The question facing policymakers is not whether these challenges exist, the data confirms they do, but rather how the administration plans to address them and what consequences American workers and consumers should expect. In this comprehensive 12-minute analysis, we are going to examine the actual economic data showing dollar pressure. We will review what economic experts across the political spectrum are saying about the causes. We will look at the policy decisions that contributed to the current situation, and we will explain what options exist going forward and what each option would mean for average Americans. This is not partisan commentary. This is economic analysis based on data, expert opinion, and historical precedent. The dollar faces pressure. The question is what happens next? Let's start with what the numbers actually show. Dollar index movement. According to publicly available data from the US dollar index, which measures the dollar's value against a basket of major foreign currencies, the dollar has experienced notable fluctuation over recent months. Financial data services report that the dollar has weakened against the euro, the Japanese yen, and other major currencies during certain periods, while strengthening during others. This volatility itself creates challenges for businesses engaged in international trade. Why this matters? A weaker dollar makes imports more expensive for American consumers. Everything from electronics to clothing to automobiles that contain foreign-made components becomes more costly. However, a weaker dollar also makes American exports more competitive in foreign markets, which can benefit American manufacturers selling abroad. The challenge is managing this balance. Interest rate considerations. According to Federal Reserve data, interest rate policies affect dollar strength. When the Federal Reserve raises interest rates, it typically strengthens the dollar as foreign investors seek higher returns. When rates fall, the dollar typically weakens. The Federal Reserve operates independently of the White House, which means the administration cannot directly control monetary policy. This creates tension when White House economic goals and Federal Reserve policy diverge. Trade deficit data. According to Commerce Department statistics, the U.S. continues to run a substantial trade deficit, meaning we import more than we export. The size of this deficit has been a focus of administration policy. Trade deficits can put downward pressure on currency values over time, though the relationship is complex and influenced by many factors, including capital flows and reserve currency status. To understand why these dollar pressures exist, we need to examine the policy decisions that created the current environment. Tariff implementation. According to the Office of the U.S. Trade Representative's public data, the administration has implemented significant tariffs on imports from multiple trading partners over the past several years. Economic theory suggests that tariffs can affect currency values through multiple channels. They reduce imports, which should strengthen the dollar. They provoke retaliatory tariffs, which reduce exports and weaken the dollar. They create economic uncertainty, which can cause capital flight. The net effect depends on which force is stronger. International relationship strain. According to reporting from major international news organizations, U.S. relationships with traditional economic allies have experienced strain over trade policy disagreements. When countries reduce economic cooperation with the United States, it can affect demand for dollar-denominated assets, potentially weakening the currency. Federal Reserve independence questions. Public statements from the administration have at times questioned Federal Reserve policy decisions, particularly regarding interest rates. According to economic historians, markets value Federal Reserve independence because it assures investors that monetary policy won't be manipulated for short-term political gain. When that independence appears threatened, it can create currency uncertainty. Debt and deficit considerations. According to Congressional Budget Office data, the federal deficit remains substantial. When governments run large deficits, it can eventually put pressure on their currency's value, though the United States benefits from the dollar's reserve currency status, which changes these dynamics. How are economic experts analyzing this situation? Mainstream economic view. According to surveys of economists conducted by institutions like the University of Chicago Booth School, there is broad agreement on several points. Trade wars typically reduce economic efficiency and raise prices for consumers. Currency values reflect complex interactions between trade flows, capital flows, and monetary policy. Sudden shifts in trade policy create uncertainty that markets dislike. Long-term dollar strength depends on confidence in U.S. institutions and economic management. Conservative economic perspective. Economists who support the administration's approach, including those at conservative think tanks, argue that short-term economic disruption is worth it to address what they view as unfair trade practices. A somewhat weaker dollar benefits American manufacturers by making exports competitive. Prioritizing domestic production over cheap imports serves long-term strategic interests. These economists emphasize that currency values should not be the only metric for judging economic policy. Progressive economic critique. Economists who criticize the administration's approach, including those at progressive research organizations, argue that tariffs function as taxes on American consumers who pay higher prices. Trade wars damage relationships with allies that took decades to build. The benefits to protected industries are outweighed by costs to the broader economy. Currency instability harms American businesses trying to plan international operations. The areas of agreement. Interestingly, economists across the spectrum agree that the current situation involves economic trade-offs with winners and losers. Currency policy cannot be separated from broader economic strategy. Uncertainty itself has economic costs, regardless of eventual outcomes. What do these currency pressures mean for ordinary Americans? For consumers, according to economic analysis, dollar weakness affects consumer purchasing power in several ways. If you buy electronics, the components are often manufactured abroad. A weaker dollar makes these more expensive. If you travel internationally, your dollars buy less in foreign countries when the currency weakens. If you buy gasoline, oil is priced in dollars globally, but currency fluctuations can still affect prices through complex market mechanisms. For workers, the employment impact is more complex. Workers in export-oriented industries may benefit from a weaker dollar if it makes their products more competitive abroad and preserves their jobs. Workers in import-dependent industries may face challenges if higher costs lead companies to reduce operations. Workers in completely domestic industries may see little direct effect, but could face higher prices for goods they purchase. For retirees, currency fluctuations affect retirement security in multiple ways. Social Security payments are denominated in dollars, so currency weakness doesn't directly reduce benefits, but it reduces purchasing power for imported goods. Investment portfolios with international exposure can be affected by currency movements. The Federal Reserve's response to currency pressure through interest rate changes affects returns on fixed income investments like bonds. For businesses, according to business surveys, currency uncertainty creates planning challenges. Companies that import materials face unpredictable cost structures. Companies that export face changing competitive dynamics in foreign markets. Multinational corporations face complex hedging decisions to manage currency risk. What can the administration actually do about dollar pressure? Option 1, adjust trade policy. The administration could negotiate tariff reductions with trading partners to reduce economic tensions and uncertainty. According to trade economists, this would likely reduce some downward pressure on the dollar by improving the overall economic outlook and reducing retaliation against American exports. However, this would require the administration to acknowledge that current policy needs adjustment, which would be politically challenging. Option 2, accept dollar weakness. Some economists argue that a weaker dollar is actually beneficial for the administration's goal of boosting American manufacturing. The administration could explicitly state that it views current dollar levels as appropriate or even desirable for rebalancing trade. However, this creates risks. If markets interpret this as the U.S. abandoning its traditional commitment to a strong dollar, it could trigger more significant currency decline than intended. Option 3, coordinate with the Federal Reserve. The administration could work with, not direct, the Federal Reserve to coordinate fiscal and monetary policy in ways that support currency stability. However, the Federal Reserve operates independently, and any appearance that it's coordinating too closely with White House political goals could damage its credibility. Option 4, negotiate international currency agreements. The U.S. could work with other major economies to coordinate currency policy, similar to historical agreements like the Plaza Accord. However, this requires international cooperation that may be difficult given current trade tensions. The reality. According to economic historians, currency issues rarely have simple solutions. They reflect broader economic fundamentals that take time to shift. This is the economic reality as of late January 2026. The US dollar faces pressure from multiple directions. Trade policy decisions have created economic uncertainty. International relationships have been strained, and the administration must navigate these challenges while facing political constraints on what policy options are available. Economic data shows these pressures are real. They are not manufactured controversy. They are the measurable consequences of policy choices made over the past several years. The question now is not whether challenges exist, but how policymakers respond and what consequences Americans should expect from those responses. Different economists offer different solutions, reflecting different values about what the economy should prioritize. Some emphasize protecting domestic industries, even at the cost of higher consumer prices. Others emphasize efficiency and lower prices, even if it means more import competition. These are legitimate debates about trade-offs, not questions with obvious right answers. What matters for American families is understanding how these debates affect their daily lives, their jobs, their purchasing power, their savings, their economic security. We will continue monitoring economic data as it's released. We will track policy decisions and expert analysis, and we will explain what it means for the people whose lives are affected by these abstract-sounding currency movements and trade policies. This is complex economics, but it has real consequences. Subscribe for continuing analysis based on data and expert opinion from across the political spectrum. The dollar faces pressure. How we respond will shape American economic reality for years to come.